Has anyone seen headlines about the economy recently? Like, it gets you really excited, right? Uh, just remember one thing. The news, they have an objective, and it's to sell your attention, and fear sells. So they sell fear. It works. I'm not saying don't watch the news, just know that that's what they're doing. But also know that, kind of remember what Warren Buffett says, like, be fearful when others are greedy, be greedy when others are fearful. There's this too. Red's been kind of a common color on Wall Street as of recently. I think I don't have any stock other than what I get gifted through my brokerage, but I think it's the past couple of days has probably been a little bit greener than this. But what's actually going on? Like, is this some sign that the world's crashing and the economy is going to crash and, I don't know, China's going to take over? There's something else going on. Might be. Looking at GDP, despite a slow start last year, and the Fed, they've had a pretty firm mandate. They're trying to slow things down. They want to tame inflation. They've had this higher for longer strategy, and it seems like it's going to be higher for longer. The U.S. economy has been pretty darn resilient. Real GDP and the growth in Q4 of last year was 2.3% below expectations and below Q3. So Q3 is 3.1, so a little bit below that. Annually, though, last year we were at 2.8% GDP, 2024. That's only it's slightly below 2023. So 2023 is 2.9%, 2.8% 2024. Not bad, especially with everything the Fed's been trying to do to slow things down. Now, that was last year. Like, what's going to happen this year? Probably going to be a little bit slower. At least that's what the Atlanta Fed's predicting. So has anyone seen this chart? It's the Atlanta Fed now. So it's a real-time tracker. They're predicting Q1 GDP at negative 1.8%. Now, going for positive 2.8 to negative 1.8. That's a 4.6 point swing. That's pretty huge, right? That's a huge swing. Now, this is in line with overall expectations that the economy is going to slow down. It is important to note that this is a very volatile tracker. Every time they get new data in, and we're obviously in the middle of a quarter, every time they're getting something new in, it calculates in real time what their estimate's going to be. It's been as high as positive. It's been as low as negative 2 something. Now it's at 1.8. We'll see what happens, but ultimately, it's looking like it will be a little bit lower than last quarter at least. Inflation has been the hot topic for several years now. Is anyone tired of hearing about inflation? Like, there was a time in our life, if you can really think hard, there was a time when you could actually go a day or a week and not even hear about inflation. Like, those were the days, right? Well, the good news is it's cooled significantly since 2022, and it's come way off its peak. It seems to be kind of under control-ish. It's still elevated, and it's stubbornly been sticking near 30-year highs, so it's definitely still elevated, especially if you're buying eggs or whatever. But since May of last year, it's kind of been flat and a lot higher than what the Fed would like. So although the latest, if you're a nerd like me and you actually look at the stuff, the wholesale and consumer price indexes, they came down lower than expected. That's good news. But really, we're going to have to see, and the Fed's going to want to see how things continue going forward before they make any rate cut decisions. We'll see how things are going to go in the future, and especially when it comes to tariffs. How's that going to impact inflation? Unemployment, though. I hear this a lot about the employment numbers. Unemployment remains at historic lows, 4.1% in February. In May of 2024, unemployment reached 4% for the first time in 5 years if you exclude the COVID period. It edged up to a high of 4.2 in July. It's kind of floated between that 4 and 4.2% since then. But in this latest unemployment data report, one interesting piece of information came out, and it kind of maybe think a little bit, and that's part-time workers hit their highest level ever. Interesting. Could be concerning, right? Well, let's look and see what that is. This is part-time employment numbers. This is what it looks like for the past 30 years. You can see in the 90s, during the internet boom, huge spike. Everyone's getting their .com gigs, or they're learning about the gig economy. Then, after the great financial crisis, spiked again. Then it was pretty much flat, which I was actually kind of surprised to see this. I figured it would have been a more steady rise, but it's been kind of flat all the way up until COVID crashed, like everything else crashed in COVID. Then it's been on the rise, and we just hit recent highs. It's not that high, though. Time will tell how this gig economy continues going forward. Maybe 20 years from now, we all have part-time jobs. But as far as how it relates to full-time employment rates, it's not that much of a change yet. Something to watch, but as far as that headline, doesn't really worry me right now. Wage growth stabilized around 4%, at least after retreating from the COVID highs. Normally, that would be considered strong wage growth. Unfortunately, a lot of households are still playing catch up from COVID, and it's just going to take time. There's still a lot of Americans and families out there that are struggling and dipping into savings to just pay for everyday activities, or probably pay for a lot of stuff that they don't need. But that's neither here nor there. Wage growth is strong, but it's still lagging behind several years of high inflation. Now, the Fed, they had their meeting yesterday. They decided to hold interest rates. It was pretty much baked in. Most people expected that, although there was maybe some optimism that they might decrease them. But no, they held them. They did say, or at least they hinted, that we could be looking at 2 rate cuts this year. They also updated their outlook for the rest of the year and into next year. So with GDP, they're expecting 1.7% growth, GDP for 2025, which is obviously much lower than what we saw last year or the year before, and into 2026, 1.8%. Much slower growth. Unemployment, 4.4%. Then before retreating down to 4.3% in 2026. And then inflation, at least core PCE, 2.8%, going down to 2%, 2.2 in 2026. 2% is their target. So I don't know why they said 2%. I think they probably made a mistake when they did that, but because they're not even going to hit it in 2026. But overall, the Fed's expecting slower growth. I think most people, when you kind of look at things, what's going on, and if you have a small business or if you're an investor and you're tracking this data, you kind of already understood that. This is them putting it on paper, but the sky's not falling. I don't know that they would tell us if it is. They probably wouldn't. So I mean, how reliable is this anyway? But I mean, for what it's worth, they're saying, hey, it is going to be slower, but we're not falling off a cliff. What about real estate, though? How's real estate doing? Good for someone, all right? Hopefully more than, I heard distributions are going out on one property, someone in the crowd, but it really depends on who you ask. So some folks are a little bit bearish, some see opportunity. You see Blackstone up there, they just raised their largest commercial debt fund, $8 billion that they have. They're going to be strategically loaning out to commercial investors. Today, the National Association of Realtors released their February's existing home report. Did anyone look at this today? So existing home sales increased month over month, so from January to February, by 4.2%. But it decreased year over year. So overall, year over year, this time last year, we have less homes that sold, 1.2% less homes, but month over month, which is more of a leading indicator, it's increasing. Inventory increased from 3 months to 3.5 months. So in other words, at the current pace, it'd take about 3.5 months to sell all of the homes that are actively on the market right now. Home prices, up. Home prices are up. If you look at the headlines and you talk with folks and you think that the real estate market is crashing and homes are going to be selling 30% off market. I mean, hey, if that happens, it hasn't happened yet, because homes, the home sale prices were up 3.8% year over year. So the same home, the person that was waiting for homes to crash, they're going to pay 3.8% more for that home now. So the average median home price is $390,400. Pending home sales. This is more of a leading indicator of future sales. Now, this report comes from out not tomorrow, but next week. I was really hoping I can get it for this week. So this is January's numbers next week. You can look it up on their website. It's publicly available. Pending home sales dropped nationally by 4.6% month over month, and broken down by region. The South saw a 9.2% drop. The West, a 1.2% drop. Midwest, 2% drop. The Northeast, Yankees, 0.3% increase. So I guess they're doing all right up there. Overall, year over year, pending home sales dropped by 4.6%. Big reason is this: mortgage rates. 30-year fixed mortgage rate peaked at 7.79% October 2023. All right. Quick thing. Does anyone remember, did anyone get involved in real estate when interest rates were higher than that? I'm looking at you, Richard. And my first deal, I bought it was a subject to deal. It had, I think, a 9.5% interest rate. So historically, you stretch this chart out, 7.79, a little high, higher than average, but not crazy, but it's a lot higher than the 2%, 2.5%, 3% that we came from. So yeah, 7.79%, October 2023, that was the peak. It fell down to 6.08% in September of last year. And if you were in any real estate circles, that was like a good time, because everyone's like, oh, we're finally gonna get in the fives, like the market's gonna boom again. And then, because the Fed was cutting rates, they did 3 consecutive rate cuts, and everyone's all excited. The glory days were going to come back. And then the 10-year Treasury, which was what the 30-year mortgage is correlated to, it goes the opposite way. It goes back up and hit another recent high at 7.04% January 16th. So just when we thought things were good, it gets a little bit worse from a mortgage perspective, at least. Now, since then, kind of good news, rates have decreased for 7 straight weeks, other than the last 2 weeks. So 7 straight weeks. They now currently sit at 6.67%. The previous 2 weeks they went up, but it's basically flat. Like they barely moved. So excluding recent highs, you have to go back to 2007 before you see rates this high. But again, keep it in perspective. It's not that bad, but the problem is, at today's rates and today's home prices, mortgage payments 50% more than what it would have been just a couple years ago when rates were at its lowest. And higher rates, higher prices, it absolutely is impacting home affordability. And there's just no way about it. No other way to explain that. But there is one thing we can do to help this problem. We can build more houses, right? So why don't we do that? All right, so depending on houses, obviously we can build ourselves out of this problem. That's the one way that the market can fix this problem. There's a lot of things government can do. I don't know that government, we really need to wait around for the government to fix our problems, but the market could build more houses. Depending on the source you ask, the U.S. is short between 4 and 7 million housing units. Even on the low end, that's a lot of houses. It's a lot of housing units. That will not be solved anytime soon. Even if we had the infrastructure and the labor to solve that today, that takes years, and we don't have that. So excluding the pandemic spike, housing construction remains at levels below, remains below levels seen 20 years ago. Do you think our population's increased a little bit in the last 20 years? Well, we're building less houses than then. Unfortunately, it's trending in the wrong direction too. New single-family residential housing permits and starts have gradually declined from 2022 highs, and with sustained higher interest rates and construction costs, that trend isn't going to rebound anytime soon. This chart breaks out single-family and multifamily. So single-family is in red, multifamily is in blue. These are starts, so actual projects that are starting. So both of them fell from the 2022 highs. Single-family has stayed relatively stable. It's still kind of trending in the downward fashion, but it's been relatively stable. If you look closely at the chart, and it's a little hard to notice, but new multifamily construction as a percentage has pretty much fallen off a cliff. It's gone down a lot between the 2022 2023 highs. And that's just because it went up a lot too. Like most things during the pandemic, rent skyrocketed. So if you were a landlord during that time, you got some nice rent. Then it fell back to earth like everything else. Single-family rent, it rebounded a little bit last year, and there's, thought that, hey, we should be on good footing. But right now it remains at historic lows. It's in positive territory, so that's something to be happy about. But about 2%. And odds are, if you have a rental property, your expenses went up more than 2%, most likely. Taxes, insurance, anyone? Multifamily, though, completely different story with rent. So following the surge of inventory that multifamily has experienced over the last 18 months, multifamily rent has been pretty flat. So in February, rents increased month over month by 0.41%. They're just happy it's positive. For the year, 0.8%. 0.8%. So if you're a single-family landlord and you think your expenses, your taxes and insurance are crazy, talk to the multifamily guys. It's insane. Regionally, the Midwest and the Northeast, they experienced 3.1% annual growth in rent. Because they didn't build as much up there. No one's building, probably because of all the regulations, I don't know. But they didn't build as much, supply and demand, their rents kept going. Well, the West, kind of flat, 0.4%. The South, a decline of negative 0.7% growth. They just built a ton of multifamily units in the South over the last 18 months or so. But even with the South, with negative 0.7%, with the amount of units that went online over this past time, it's actually not bad. But the winds do seem to be changing because month over month rent growth went from, in November, it was negative 0.4%. Then it went to positive in January, 0.16%. Then, now we're in February, 0.41%. It's not a lot, but it's positive, and it's trending upward. And right now it's expected that that trend will continue in positive territory as all the units that went online, and those units are competing with all the existing units as the market absorbs them, as they get leased up, with fewer new construction coming on to add new inventory. That should allow, like once the inventory is absorbed, rents are expected to, towards later on this year and into next year, start increasing again for multifamily. Now that's a lot of data. There's a lot of other stuff that I could have included, like market, consumer sentiment, mortgage delinquency. I really wish I threw that slide in there. Foreclosure data. But ultimately, like, what does it all mean? What does it all mean? Like, I don't have a crystal ball. Mine broke. But based on the current data we have, I'm cautiously optimistic. What do I mean by that? I'm cautious about the economy in the short term. I'm watching economic or employment trends, unemployment, and wage growth, watching that. Obviously, if you see spikes in unemployment, then that's going to trickle down to bank accounts, which trickle down to purchasing things, paying mortgages, paying rent, that kind of thing. Watching interest rates, how that trends, and more importantly, or at least equally as importantly, is local market fundamentals. So most of the stuff that I just talked about, all this data, is macro. That's national. Real estate's very local. And you can have markets that, we could be in a recession, and you could have local submarkets in real estate that are doing really well. And you can have the inverse, where the economy's booming, and then you got markets that are still in the tank. Like, that was Detroit for a long time, at least for real estate. So I'm cautious about the economy, but I am optimistic about the long-term outlook for residential real estate. The way I see it, it really comes down to basic supply and demand. There's a lot of demand for housing right now. Most of it is being throttled by market conditions, really just affordability. But there's still currently enough demand to meet the current inventory to keep home prices relatively stable. Now again, real estate's local. It's gonna be a little different in Miami than it's gonna be in Dallas or Chattanooga. But at least from a macro standpoint, there's enough demand to meet the current inventory. And if that demand does grow, and that's whether rates decrease or wage growth increases, at least relative to home valuations, it's just going to increase the demand. And then on the other side, you have supply. So we're 4 million homes short, or housing units undersupplied currently. Construction rates are lower than they were 20 years ago. There's really no easy way to fix that, and they're still lagging. So there's just no short-term solution. So you have high demand, and a lot of that demand is being throttled back. It's being held back a bit by affordability. You have relatively low supply. And I say relatively, supply is increasing, but relative to the demand, it's still low, and we're behind. It's a pretty good outlook. So outside of some black swan event, because there could be something out there, World War III, I don't know, some bank goes out of business, there could be any of that kind of stuff. But the general overview of residential real estate looks pretty positive. A few very important things, though, and this is especially if you're going to invest as a passive investor, you have to know your market. Like every market, every submarket's different. It doesn't mean you need to necessarily go dig into all the fine little details. If you're working with an operator, which you need to know your operator, you need to know their background, their experience, their track record, their strategy. They should be providing this data from you to you, and it should be from reputable sources. So know your market, know your operator, know the asset. You don't have to be an expert. So if you're going to invest in flex industrial, multifamily, self-storage, you don't have to be the expert. That's why you're investing passively with another operator. You need to know them. You need to know the strategy. But you need to know a little bit about the asset. You need to know what the numbers mean when they're sending you over their projections and their timelines and everything. You need to know enough to analyze their strategy and their risk and really make sure that that strategy works for you and your timeline. It works for your timeline, but it also works for your market, the current market conditions. So, a short-term flip, being a private money lender in a short-term flip, that's a very different passive investment than investing in a syndication for a large multifamily ground-up development. Like completely different timelines, different strategies, different risks. You need to know what those are. The same goes for risk. Don't blindly accept a deal just because it says that you're going to get a 2.5 times return or a 21% IRR. Like you've seen these things flash across the Facebook or emails or whatever. When you get those, maybe it's a home run. Odds are it's a projected, meaning not guaranteed, projected high return with higher risks, and that's only if everything goes right. Everything usually doesn't go right. at least not perfectly. So know the risks. Know the risks. Now, in a minute, I'll open it up to questions, and afterwards, free to hang out here and network. We can open up for questions. What you got, Derek?
So I see everyone offering the 20% ROR, IRR on every syndication out there. I don't care what the syndication is, right? And I appreciate you saying like, hey, just be optimistic, which is good. So if someone chooses to invest in one of your guys' projects, what is a realistic, type of, ROI we can expect?
Yeah, so risk-adjusted returns. It's a catchy phrase, but basically, higher the return, higher the risk. That's just the market. Like I was saying, there can be opportunities where, hey, they just got a unique deal. But really, if you're talking about multifamily properties, what are they going to do? If they get those unique deals, the operator is going to carve that out because they know what their investors want, and they're going to make sure that the IRR reflects that risk. The returns for their passive investors reflect that risk. So obviously, if it's a riskier deal because it's a ground up development, takes a lot of time, they're not getting any distributions for 2 years or whatever, or if it's just dilapidated because it was a foreclosure or something like that, it's going to be a high risk deal. They're going to need to make sure that IRR reflects that to attract money. Just because an IRR return, so IRR, internal rate of return, just because a number is higher, it's not just free bonus money that you're going to get on a deal. Like, there's a reason for it. And operators aren't just going to give up free money if it's such an easy, low-risk deal. They're typically not going to give that away. They want to keep some too. So just know, it's the market. If it's a high-return deal for investors, almost certainly there's higher risk. Something's off. And me personally, when I see the stuff out there, it's almost like I just shut it down. This is just me, my filter. Some of them might be true, but when I see like 24% IRR, I'm just like, get out of town. Like, in this market, hey, good luck. I'm very, as my son would say, I'm very sus. But I mean, so before COVID, there were a lot of deals. I mean, you'd see them all the time. 17, 18, 19, 20%. And some of them actually performed that and higher. But there's also a lot of market tailwinds. We don't really have those market tailwinds right now. It's uncertain, but I would just be suspect if you're seeing something that high. Any other questions?
Yeah, so for people new to these types of investments, what do you usually recommend for people vetting these types of deals?
So first vet the operator. Well, I mean, are you talking about multifamily?
Yes.
Yeah. So, because obviously it's different, but a good operator can take a bad deal and do okay with it. A bad operator can take a good deal and run it into the ground. So jockey over the horse. You have the jockey, they're riding the horse, which is the deal, and then you have the track, that's the market. So you can't change the track, but you can put a better jockey on a horse. So it's a small world. Ask around, network, come to things like this, go to other networking events. Ask for, obviously, if folks are raising money, they've got deals. Look at those deals, ask for the underwriting, review them. Don't invest with them though. Okay. Not yet. Ask for their prior deals. Ask for their previous, marketing, their business plans on prior deals that have already closed, and then ask for their underwriting on those. How did it perform? And I recommend going through your basic analysis, doing that, depending on your timeline and your frequency. Do one a week, one every other week, a couple a month. You start to get the feel of what things look like, whether it's me or Brian or any of the other folks out there. You get a general idea, and then you start to realize like the things that you like. And you also learn through that process better questions to ask and things that the answers they give you, things that you don't like to hear and things that you do like. So do that, network a lot, talk. Operators generally don't like to talk negatively publicly about anyone because, it's a small world. But if you talk privately, you can get the idea of, I heard they've got some SEC problems, or I've got some investors in that deal, and they haven't paid distributions in the last 18 months, and they're not even responding to emails, things like that. And then you're going to hear other ones like, man, they're great. They're on the ball. Like, loved it. It's been a smooth experience. They had some where they had, every operator is going to have some issues, but they were on top of it. They were communicating well, that kind of thing. Yep, yep.
Okay, how you doing?
So, it's funny that you say that market is holding, and I see the graph, and I agree with you on the graph. But yet out here, we hear that, like you mentioned, operators are struggling, financing is coming due, and that sort of stuff. So, are you preparing yourself for anything like that? I mean, because that does two things. One is it creates a scare, and it also creates opportunity, but at the same token, it dries up funding. So, what are your thoughts on that?
Yeah, so when I say the pricing holding, is that what you're referring to? Like the market's meeting the current price? That was specifically for single family. I mean, multifamily is it's a lot different. Multifamily valuations, cap rates, they've changed a lot. Down 30-something%. During the Great Financial Crisis, I haven't looked at this data personally, but I've heard from multiple sources that that's about what multifamily fell during the Great Financial Crisis. It was about 30%. So a lot of folks really think that multifamily could be kind of bottomed out, and this may be the time where we get into a landlord-friendly era, because they're not building, to build a house, 6 to 9 months plus, planning and permitting. To build a multifamily, 300 unit multifamily property, 2 to 3 years. And they've shut that spigot off. So the stuff in the pipelines gets winds down, inventory gets absorbed. Anyone that has existing inventory, if you have a property now and you're doing okay, and you get through that, you're going to be on the positive side of that, because now you're going to see rent growth, and there's going to be no new inventory to compete with. So that's some potential tailwinds coming your way. As far as opportunities and distressed assets, I was talking with someone here tonight. I think let's just say there's billions of dollars just sitting there in dry powder. There's unlimited amount of emergency debt funds and emergency capital ready to swoop in and capture anything that looks like it's going to be a good asset. So I think a lot of and what I've personally seen and going forward, outside of some big black swan event, I think a lot of the distressed multifamily assets, they're going to go quietly. They're going to swap out GPs. They're going to plug someone else in. I'm right now negotiating on, so we've got a loan out, and they've defaulted on the loan, so we're taking that back, but they've got a portfolio, and I'm talking directly with the lender on the entire portfolio. It'll never hit the market. So I think the most of those will probably just never hit the market. It's going to go quietly on the back end. Could be some distressed, but yeah, having access to capital, that never hurts. Why do you think I made this event? It's a good way to network folks, teach folks how to invest, and I don't know, maybe one person may want to invest with me, maybe not. Maybe we just get some nice food. But yeah, network, always be raising capital. So always be closing, always be marketing, but always be marketing for two things: deals and dollars. Deals and dollars.
So the distressed properties you're speaking about, those are single family ones or the multi?
The one that I was just talking with him, where we're about 30% down, so it's multifamily is, but so multifamily, like commercial loans, they're short term. So 2, 3, 4, 5 years. And they're also most is floating rate. So with 30, and I didn't know this when I was looking into commercial, years ago. I was like, oh wow, that's interesting, because you go from residential and like, who on earth would ever get after the Great Financial Crisis would ever get a floating rate debt? That's stupid. It's different with commercial. And the reason is you can get fixed with commercial, but what if you get a good buyer? You get a 10-year fixed loan. You're year 3 in. You get a good buyer. And it turns out that your prepayment penalty to get out of that is going to be like $3.5 million. That sucks. So most commercial lenders or commercial investors, they'll usually get floating rate because it gives them that flexibility. But there's risks to that. And a lot of operators realize some of those risks when we saw interest rates go from the low, like, high 3s, low 4s, all the way down to up to 7 and 8 within a couple months. And they caused a lot of problems because the strategy was buy with bridge, floating rate, fix it up, lease it up, kind of like the BRRRR strategy for multifamily, and then refinance later on. But now they couldn't refinance because the numbers didn't work anymore. So that's the problem. That's what he's getting at, because there is a lot of money out there in commercial loans that is up for renewal, but so far the banks have been willing to work with them and kind of kick that can down the road. But banks have tolerance. They've got rules they have to follow, and if they can make it work, they will. If they can't, they'll take it back. It's just, how's that going to work? Is it going to be off the table, or are we going to see like a flood of inventory? So far, people have been talking about this flood for 2 years. I haven't seen it. I don't think it's coming based on current conditions, but hey, I could be wrong. And if it does, I'll be happy. Not for them, like, sucks for them, sorry. But I mean, hey, it is what it is. I'll be happy about the opportunity. I'll be ready to buy, but it is what it is.
We've been talking about pretend and extend for 30 years.
Yeah.
But on the multifamily I've seen go back, the operators were great promoters. They knew how to raise money. They didn't know how to operate apartments. So what I would tell people that were looking to get into a deal passively, show me what you've done, and then go look at it.
Yeah.
Don't listen, look at it.
Oh, yeah.
Because
Do site tours.
if what they've done is garbage, what you're getting in is garbage. I'd rather be with a true operator than a promoter.
100%. Yeah. So, and that was my strategy with contractors too. Like, a lot of contractors, they can tell you a good story, show you some beautiful pictures before and afters, but then let's go check out some job sites. Some that you're just starting, some you're in the middle, some you're at the end. And when you see beer cans all in the middle of a project, there's beer cans, there's like 2 people there, and trash and all this stuff. And like, that's how your project's going to be. Do you want that? So same thing with another operator. And that's why I also like going to looking at their business plan from a long time ago and how that's performing today. To be fair, there's some really good operators. I mean, they're not immune to the market. Like, it just happens. It should be a rare case for them, though. Because I was talking with some operators over the last, because I was before I was like heavy into multifamily, and saw some guys moving in. I was like, be careful. Like, the gravity of interest rates, there's really only so much lower it could go, but there's a lot higher it could go. I was like, just be careful. Well, but talking with folks that have been in multifamily for 20, 30 years, several of them, they're just like, we're not buying. We're selling everything we can. And they were just waiting. So those are the guys those guys with the radar, and they've got these scars from previous market cycles that they've learned from. They're potentially good partners. Yep.
Chris, let me ask you, when I'm looking at a multifamily deal and I'm trying to evaluate it, given the cap rates, or taking a look at the cap rates, we agree that the higher the cap rate, the riskier the asset would be. What is a cap rate in today's market you think is adequate to take on? That's not too risky, but it's still worth the time and reward to invest in.
Yeah, so it's going to be very local specific. And also, it's going to be different between a Class C, Class B, Class A, and also the size of the property. And cap rates in themselves, I mean, you're probably, especially if it's a value add, it is going to be higher because you have a lot of value you can force into that. But there has been some trending downward with cap rates, but there's still a big bid-ask spread. But working with the local brokers in the local market that you're trying to buy in, that's what you're going to have to do. In addition to that, talking and networking with the other operators that are in that market, seeing what's going on, and working with the lenders. That's what you need to do. Are you in the Houston market?
Yes, the Houston market, Class B specifically.
Okay. Yeah. Brian, if you haven't met Brian, he's someone really good to talk to there. What's going on, Michael?
Hey, Chris. So, would you be accepting a broker's cap rate?
Trust but verify with everything. But you got to know, the broker has a job, and they're there to sell a property, and they want to get the highest possible price for their client and their pocket. Like, that's their goal. Now, where I fit in with the whole, like, with our fund, like, I don't talk to brokers. It's just, I'll talk to them, but I'm not the one out there scouting deals. We look for money. Because you have multiple different jobs with multifamily. It's just where I focus on. But yeah, it's information. Trust but verify. Just like everything else, like, do you trust wholesalers' repair bids? That was a joke.
I laugh.
All right. What's up?
I guess another question I have for you is understanding the market, what's going on. And I'm asking this from a pure curiosity question. Are you choosing apartments because that's what you know, or is that the best opportunity that's coming?
So with single family right now, I'm like I mentioned early on, like, I'm still interested. I'm just a bit more strategic about it. Like, I know Sugar Land because I live in Sugar Land, and when I had a deal that was in a nice, like, blue collar neighborhood that I know, and it was cosmetic only, and I knew it would sell, like, that was a no-brainer. I'll take that deal. If you're just going to throw me some deal in Beaumont, not that interested. It's not that, and it's not that I'm not interested in Beaumont. Well, I am not interested in Beaumont. It's not that Beaumont's a bad market. It's not what I'm looking for. But for me, it was. Is someone from Beaumont? I'm from Sugar Land. I got to take a flight over there. That's it. So if I lived in Beaumont and you had a good deal for me, yeah, I'd be interested. So for me, we flipped 200 houses or so. And I was mentioning to you before, like, if Jamie and I, if we could have, like, flipped 30 to 50, but kept them all, like, that would have been really nice. I kind of moved into the multifamily because I was like, well, how do I scale this thing where we can hold more? And I don't want to own 200 single family properties. So multifamily is much more better scales of economy.
Can I follow up?
Yeah.
So, and why, so we were having this conversation earlier, but it's the transgression of the real estate investor, right? I think it's just multifamily is the next shiny object, or if you're following a ladder, it would be the next step. And that's what I'm asking is, like, what about, you mentioned flex space, you mentioned industrial, there's a lot of other opportunity out here that we just, and been in the same circles with people, never gets talked about, and now we're exposed to that, and that's coming up, and I think that's an opportunity. That's why I was curious, like, are you raising your fund for multifamily because that's what you see the opportunity, or that's just what you're comfortable with?
I know residential real estate, so it's a pretty simple transition. All those other things, well, let's just say there's nothing new under the sun. So flex, industrial, and self-storage and all this stuff, these are all asset class. They were here 10 years ago. They're here today. They're going to be here tomorrow. There's nothing, and there's already a market for them. So you're not really creating anything new. You're not, like, stumbling across anything new. There may be new, unique ways that you could, like, go about it, but by and large, there's a market. It exists, and you're going to have a certain set of return for whatever that asset class is. For me, it was just residential, sticking on that side. But yeah, I know folks that are in mobile home parks. That's still residential, a little different, but self-storage, flex industrial, and assisted living, which that, although residential, it's more on the service side. So it's a pretty hard break from what I do. But yeah, you can do any of those things, and you can do really well with any of those things. A lot of them have their own cycles, like office. Not really the best time from a high part of office. Maybe it's a low. Maybe it's a good time to buy office. I don't know. But that's another one.